All right, so you're here because you really want to get under the hood of what drives business performance, right? How
Yeah.
companies actually create value for their shareholders. And that's exactly what we're going to do today.
Yep, we're diving deep into Hang Seng Bank's 2024 annual report.
Yeah, we've been poring over this thing, pulling out the most important insights so you don't have to.
Think of it as your shortcut to understanding how Hang Seng Bank is approaching their business, their financials, and how they plan to deliver value to shareholders like you.
So, right off the bat, the chief executive talks about 2024 being a year with, and I'm quoting here, continued geopolitical and macro
All
challenges.
right, set the tone, doesn't it?
Yeah, it definitely does. So, how did Hang Seng Bank navigate this tricky environment? What was their strategy?
Well, what's interesting is they took a really proactive, multi-pronged approach. They weren't just sitting back and waiting for things to get better.
Mm-hmm.
A big focus was on diversifying their revenue streams, so not putting all their eggs in one basket.
Makes sense.
At the same time, they were laser focused on growing their customer base in specific high potential segments.
Right.
And maybe most importantly, they took steps to actively de-risk their portfolio, which in a year like 2024 was really smart.
Yeah, absolutely. Adaptability seems to be crucial these days. And speaking of adapting, Hang Seng Bank is making a big play in the Greater Bay Area, right? The GPA.
Huge focus for them. The report highlights their commitment to the region.
And what were some of the concrete steps they took?
Well, for one, they've set up 9 cross-boundary wealth management centers in major GBA cities.
Wow, 9. So they're really putting their money where their mouth is.
Exactly. And it seems to be paying off. New account openings by mainland customers surged by 81% year on year.
81%, that's incredible.
It is. It is. And that jump really points to the success of their targeted approach in the GBA. They streamlined the account opening process, made it easier for mainland customers to do business with them, and those customers responded.
That's a real win for them. And they even got some pretty prestigious recognition for their efforts, right?
Absolutely. They were named the best domestic bank for the Greater Bay Area
Yeah.
at the Euromoney Greater Bay Area Awards in 2024.
Not bad, not bad.
Not bad at all. It's not just a trophy either. It shows they really understand this crucial economic zone, and they're excelling there.
Yeah, for sure. Now let's zoom in on one of their key growth engines, their wealth management business. It seems like they had a pretty banner year.
They did. They did. Their wealth management income saw a significant jump, up HK $1,241 million to reach HK $6,934 million. That's a 22% increase.
So where did this growth come from?
Well, it's pretty broad-based. Strong performance across their retail investment funds, securities broking, and structured investment products. A real sign of a healthy, active investment environment among their clients.
And it wasn't just about getting more out of their existing client base, right? They also attracted a whole bunch of new customers, particularly in those affluent segments they're targeting.
That's right. Their affluent client segments grew by a solid 15% year on year. But what's even more impressive is the 75% year-on-year increase in new-to-bank customers from those affluent groups.
Wow, 75%. That's massive.
It is. It shows that their strategy of attracting new high-value clients is really working. They're clearly doing something right.
And they're not just attracting these clients, they're building specialized services for them, right?
Exactly. They're really leaning into that Prestige Family Plus brand.
Right. What's that all about?
It's a suite of services designed specifically for their high-net-worth individuals and families.
Makes sense. And it seems to be working.
Absolutely. Account openings in that Prestige Family Plus segment jumped 41% year on year. And they keep adding new features and perks, things like Global Money Plus for, easier international transactions, and the Prestige Multi-Currency Debit Card. They're really catering to the, complex financial needs of these clients.
Smart. So looking at the numbers, this focus on the affluent segment seems to be paying off in a big way.
It is. Their wealth management income in the second half of 2024 was 11% higher than in the first half. And a lot of that is thanks to the growth in these affluent customer segments.
Yeah, the numbers speak for themselves. Now, it's clear that technology plays a huge role in their ability to scale and deliver these sophisticated wealth management services. What did the report have to say about their digital innovations?
Oh, they're all in on digital. Big time. They made it easier for customers to access and manage complex products online. Things like capital-protected investment deposits and structured notes, now they're just a few clicks away.
That's convenient.
Very convenient. And they've rolled out new financial planning tools like Wealth Master, which gives clients more control and insight into their investments.
So they're not just digitizing, they're using technology to empower their clients.
Exactly. And the clients are responding. Investment account openings through digital channels skyrocketed by 324% year on year.
324%. That's wild.
It is. And their modal active customer base grew by a solid 12% year on year. So they're definitely on the right track with their digital strategy.
It's good to see they're not just focused on the bottom line, they're also making moves in the sustainability space.
Oh, yeah, sustainability is a big priority for them.
Yeah.
They're not just paying lip service to it either.
Right. What are some of the tangible things they're doing?
Well, they launched this massive HK $80 billion sustainability power-up fund to support, green and sustainable financing projects.
80 billion. That's serious money.
It is.
Yeah.
And they're not just focusing on the big players. They partnered with the Hong Kong Quality Assurance Agency to create the SME Green Equipment Financing Assessment Platform.
And what does that do?
It helps smaller businesses, SMEs, make the switch to more eco-friendly equipment and practices.
So they're walking the walk, not just talking the talk.
Exactly.
And it looks like they're using technology to better serve their business clients as well, right?
Oh, yeah. They've revamped their business e-banking service.
And how has that been received?
Really well. Active mobile banking users among their business customers are up 24% year on year, and internet banking users are up 6%. So clearly, their business clients are embracing the shift to digital.
That's a positive sign. All right, let's talk about their global banking division. How did that part of the business fare in 2024?
Okay, so in global banking, their net operating income, before you factor in expected credit losses, only increased slightly, about 0.5% year on year.
Okay, so not a huge jump there.
No, but here's the interesting part. Their expected credit loss charges decreased significantly by a whopping 66%.
Wow, 66%. That's a big drop. Why is that?
Well, they strategically reduced their exposure to mainland China's commercial real estate sector, which has been facing, some headwinds.
Yeah, that's been a concern for a lot of banks.
It has. And because they de-risked in that area, their profit before tax in global banking jumped by a healthy 33%.
So even though they didn't see huge revenue growth, their careful risk management really paid off.
Exactly. And they managed to grow their non-interest income in global banking by 9%, even though their customer loans and advances actually declined by 6%. Again, showing they're not solely reliant on lending for revenue.
Yeah, diversification seems to be a recurring theme here.
It is. And one more thing, their bond assets under management increased by a crazy 62%. So there's definitely a shift happening in how they're managing their investments.
Interesting. Now, it wasn't all sunshine and rainbows. The report did mention some challenges that Hang Seng Bank faced during the year.
Right. Wait.
What were some of the major headwinds they encountered?
Well, they had to deal with slower economic growth, especially in Hong Kong,
Yeah.
and a downturn in the trade and retail sectors, which created tough conditions for a lot of their local business clients. And this all put pressure on their net interest income, especially as interest rates started declining in the second half of the year.
That makes sense. And then there's that whole issue with mainland China's commercial real estate sector, right?
Yeah, that's a continuing challenge. The report specifically mentions weak market fundamentals and refinancing risks as ongoing concerns. Now, they've been proactively managing their exposure there, but it's definitely something they're keeping a close eye on.
For sure. Were there any other broader market trends impacting their lending activities?
They did see a softening in overall loan demand, which, is typical in the slower economy. Businesses get a little more cautious about taking on new debt.
Understandable. Now, the report also talked about some of the complexities in the regulatory and geopolitical landscape.
Right.
What kind of risks are they facing in that area?
Well, China's evolving laws around data privacy, national security, and cybersecurity are creating some, potential hurdles for international banks like Hang Seng, especially when it comes to things like sharing data within the group and managing financial crime risks across borders.
Yeah, that sounds tricky.
It is. And then you've got the ongoing geopolitical and macroeconomic uncertainties, shifts in U.S. policy, sanctions, trade restrictions. All that creates a complex web of compliance issues, reputational risks, political risks. It's a lot to manage.
For sure. And of course, there's the ever-present issue of climate change.
Absolutely.
How is Hang Seng Bank addressing those risks?
They're fully aware of both the physical risks of climate change, like extreme weather events, and the transition risks associated with moving to a low-carbon economy.
Right.
And they're integrating those considerations into their long-term strategic planning and risk management.
Okay, so we've covered their different business segments, their strategy, and the challenges they're facing. Now let's get to the nitty-gritty. How did they actually perform financially in 2024?
Well, the big picture is one of solid improvement.
That's good to hear. Let's break it down. What were some of the key financial highlights?
All right, starting with the income statement, we see some good upward trends. Their net operating income, before you take into account credit losses, increased to HK $41,537 million in 2024, up from HK $40,822 million the year before.
Okay, so that's positive.
It is. And that growth filtered down to their operating profit, which rose from HK $19,946 million to HK $21,558 million.
And did that positive momentum continue all the way to the bottom line?
It did. Profit before tax increased to HK $21,014 million from HK $20,105 million. And the profit that can be attributed to shareholders also went up, reaching HK $18,379 million in 2024 compared to HK $17,848 million in the previous year.
So, good news for investors.
Yeah, their earnings per share also increased from HK $8.97 to HK $9.33.
Okay, so what were the main drivers behind this improved financial performance?
Well, one big factor was the increase in their non-interest income. That jumped by a significant 17%, or HK $857 million.
So those efforts to diversify their revenue streams are really paying off.
Definitely. And it's a good thing they did because their net interest income actually dipped a bit.
Really? Why's that?
Mainly because of those declining market interest rates we talked about earlier. It had a more pronounced effect in the second half of the year. Their net interest margin shrank by 16 basis points to 2.13%.
So they were squeezed a little bit on that front.
They were. Now, on the expense side, their operating expenses rose by 4% to reach HK $15,193 million.
Okay, so what contributed to that increase?
Well, they had higher amortization costs because of their investments in those new IT systems. Overall, IT costs were up as they enhanced their digital offerings. And staff costs also rose due to higher wages, performance bonuses, and increased insurance premiums. So while their revenues were growing, they were also investing heavily in their technology and their people.
All right, makes sense. Now let's turn to the balance sheet. What were some of the key changes in their assets and liabilities?
Their balance sheet definitely expanded. Shareholders' equity increased to HK $169,522 million at the end of 2024, up from HK $168,168,131 million at the end of 2023. Total assets grew more substantially, hitting HK $1,795,195,196 million, up from HK $1,692,094 million. And their total liabilities also rose to HK $1,625,674 million from HK $1,523,963 million.
So growth across the board. Now, I know the annual report doesn't explicitly lay out a cash flow statement, but can we get any sense of their cash flows from the information we do have?
Oh, for sure. Those increased operating expenses related to IT systems and digital capabilities, that tells us they were spending a lot of cash on tech investments.
Uh-huh.
And the launch of that massive HK $80 billion Sustainability Power-Up Fund.
Yeah.
Well, that signals some serious future cash outflows related to their green financing commitments. And of course, the shifts in their loan portfolio, like the shrinking global banking loans and the growth in other areas, that would have impacted their cash flows as well. So even without a detailed statement, we can still get a decent picture of their cash inflows and outflows.
All right, that's helpful. Now, finally, let's look at some of the key financial ratios that give us a sense of their efficiency and overall financial health.
Okay, so their return on average, ordinary shareholders' equity, held steady at a solid 11.3% for both 2024 and 2023. That means they're consistently generating good returns for their shareholders.
Right.
Their post-tax return on average total assets also saw a slight improvement, going from 1% to 1.1%. And their capital ratios, the CET1, Tier 1, and total, they all dipped a bit, but they're still well above the regulatory requirements. So their capital adequacy is strong.
That's reassuring.
And their liquidity ratios, the LCR and the NSFR, both saw some pretty nice improvements, which means their short-term and long-term funding positions are in good shape.
Okay, so a pretty solid picture of financial stability. Now let's shift gears and talk about how Hang Seng Bank plans to deliver value directly back to its shareholders. Dividends and share buybacks are the usual tools here, right?
They are. And in 2024, Hang Seng increased their total dividends per share to HK $6.80, up from HK $6.50 in 2023. That shows their commitment to rewarding shareholders through those direct dividend payments.
And the report actually gives us some insight into how the board makes those dividend decisions, right?
Yeah. It emphasizes that the board has the final say on dividends. They consider a whole bunch of factors: regulatory requirements, the bank's financial performance, available reserves, business conditions, strategic objectives, capital spending plans, you name it.
Sounds comprehensive.
It is. And they generally aim to declare dividends on a quarterly basis, barring any unusual circumstances. So that provides investors with a nice regular stream of income. Their dividend payout ratio also inched up to 72.9% in 2024 compared to 72.5% in 2023.
Okay. And they were pretty active with share buybacks as well, right?
Yeah, between April and September 2024, they completed a HK $3 billion automatic share buyback program.
$3 billion. That's not insignificant.
Not at all. These buybacks are a way to enhance shareholder value by reducing the number of outstanding shares, which can boost earnings per share and potentially support the stock price.
Smart. And their overall approach to capital management seems quite prudent.
It is. At the end of 2024, their capital ratios were strong. CET1 at 17.7%, Tier 1 at 19.4%, and total capital at 20.8%, all comfortably above the regulatory minimums. They were also active in the AT1 capital market, redeeming existing instruments and issuing new ones in June and September, so they're definitely managing their capital structure proactively. And as we mentioned earlier, their shareholders' equity increased to HK $169,522 million.
So taking everything into account, all the information we've gleaned from this report, what's your overall assessment of Hang Seng Bank's business going forward? What are the key takeaways for our listeners?
Despite all the geopolitical and macroeconomic uncertainties out there, I'm cautiously optimistic about Hang Seng Bank. They've shown real resilience, and they've been able to deliver some solid financial results in a pretty tough environment. Their strategy of diversifying revenue, targeting high-growth areas like the GBA and wealth management, and proactively managing risk seems to be working.
And they're investing in future growth drivers as well.
Yeah, those investments in digital capabilities and their commitment to sustainability are going to be crucial for them in the long run. Their focus on growing their customer base, especially in those affluent segments, and the recognition they've received for their customer service, it all points to a customer-centric approach, which is great to see.
Of course, they're still facing challenges.
Oh, absolutely.
Like what?
Well, those headwinds in the commercial real estate sector, particularly in mainland China, and the shifting interest rate environment, those are things they're going to have to manage carefully.
Right.
But all things considered, their 2024 performance was strong. They've got some solid strategic initiatives in place. So I think they're well positioned to navigate the complexities of the market and deliver value to their shareholders.
So to sum it all up, our deep dive into Hang Seng Bank's 2024 performance has revealed a company that's not only resilient but also focused on growth. They're diversifying their revenue, targeting key customer segments in regions like the GBA, and managing risk effectively. They're also rewarding their shareholders through increased dividends and those share buybacks, all while navigating a pretty tricky global landscape.
And this brings us to a final thought for you, our listeners. Given Hang Seng Bank's clear focus on the Greater Bay Area and their ongoing digital transformation, what opportunities and potential roadblocks do you think lie ahead as they continue to pursue these strategies? It's worth considering how regional economic development, rapid technological advancements, and those ever-shifting global financial dynamics might shape Hang Seng Bank's path in the years to come.
Thanks for listening to The Deep Dive. See you next time.